On Monday, markets were really confronted with a move over the weekend that seemed unprecedented. The Saudis announced that they were increasing the production of oil upon the failure of the OPEC talks. It's very strange looking on the surface for a producer to be increasing supply in the face of decreasing demand. The coronavirus has certainly put a dampening on the world economy and on travel, which is decreasing demand for crude oil. So why would they do this? The Saudis are not irrational. They're not crazy. They're certainly not stupid. Why would they do something that looks so strange on the surface and so disruptive to the markets? The story that came out of last week's OPEC meetings was that they failed to reach consensus on the amount of production cuts that they were going to put through. Typically, OPEC, being a cartel, agrees to cut production when demand decreases in order to provide some sort of floor to prices. So oil is not necessarily a freely trading supply-demand commodity because it is managed to some extent by this major cartel. But there are outliers, and the Russians turned out to be an outlier. The Russians did not want to cut in the face of this. And so what the Saudis did was punitive, to punish the Russians by saying, okay, you don't want to cut production? Fine, we're going to increase it and just drive the price down, and you guys deal with it. And being the major producer, the Saudis can probably deal with it better than anyone else. There was collateral damage in that, and that really came through in the face of North American frackers and shale oil producers, both in the U.S. and Canada. The problem with these producers are, in many cases, they're very highly levered. They've had to borrow a lot of money for relatively small companies in some cases to get their production going. And because they're getting some of the hardest oil to get, whether by fracking underground or whether by converting oil shale into crude oil, these are very expensive ways to do it, and they have some of the highest break-evens of anyone in the industry. The good thing about having a high break-even point is if the price goes above your break-even point and you're high, you're pretty highly levered to that price, and so you really can reap the benefits of that high oil price. The downside of having a high break-even is that you're very susceptible, and the opposite problem, you're very susceptible if the price trades below that break-even. The problem being extracting and selling the crude oil is unprofitable, but yet you still have debts to pay. And so that's a very untenable situation for a lot of the junior producers that were already sort of flirting with some trouble with oil trading. Let's call it around their break-even point when it was around $50. Now we're well below that. Let's say the low 30s when we're taping this. So what does that mean going forward? We've already started to see dividend cuts because I think it's unreasonable to expect that even some of your bigger producers will be able to pay out at the rates they've been paying. Oil companies have tended to have high dividends. What I would look for here, though, is I would be looking for oil producers or integrated oil companies that look like they could maintain their dividend, or if not maintain their dividend, if you say something that if you said, okay, we're going to cut this dividend by some huge percentage, but by the way, it's still going to pay a pretty high dividend. That would be the way that I would be looking to play this. I think ultimately this is not a long-term price move. I think somebody's going to blink, whether it's the Saudis or the Russians, we'll see. But I think in both cases they wanted to sort of hamper the U.S. and Canadian producers, because the fewer producers they have at high prices, the more control they have over the price of oil. So I would be looking for larger, diversified companies with dividends that if they were slashed, they're still paying you a fair return, pretty high return. Remember, you're looking at bond rates sub 1% in the U.S. So if you can earn some yield, that's not necessarily a bad thing. I realize there's also ESG concerns, environmental and socially responsible investing concerns. So if you think that way, you're probably not watching this video anyway. But what I would be looking for here, and this is more of a broader market sense, is I think you're going to get to a point where oil starts to rebound just because nobody wants these prices down here. Consumers do, but none of the producers do. And secondly, I think you're going to get a general hunt in the market for some yield. You're not getting it anywhere in fixed income. I think people are going to start to look for it in equities. And so if you can find a company that can pay dividends consistently at a rate well above the 10-year Treasury, that's probably something to be looking for in the marketplace.